July is historically the best month of the year for the stock market, but we're starting to see some cracks, which could indicate that this July could be different. We might actually see stocks go down this July, even though they usually go up. Even though July is historically the best month of the year for stocks, it's not automatic. Some things have to happen in order for the stock market to rally again this July. The biggest factor for July rallies has been corporate earnings. Typically, the largest U.S. companies will report their corporate earnings for the second quarter before the end of July. And in fact, earnings season starts again on Friday. Earnings season gets a little bit of an early start on Thursday with Delta and PepsiCo and Progressive all reporting, but we officially kick off on Friday with JP Morgan Chase, as well as a number of other banks, including Citi, Wells Fargo, and State Street and BlackRock. Now, anybody who's looked at the economy knows that even though some of the past economic data appears to be extremely good and shows that the economy is extremely strong, such as the fact that the unemployment rate is quite low and headline inflation is coming down, there are some concerns because at the end of the day, stocks are going to rise or fall, not based upon what's really happening in the economy, but really what's happening with earnings. See, people will look at the economy and they'll try to use that to determine if company earnings are going to go up or down in the future. And based upon that, historically, stocks generally will beat earnings expectations for the second quarter. And as companies start to report second quarter earnings, this is what causes a massive rally in July. But the early reporters, those companies that have reported a little bit before the official start to earnings season, have actually not beat expectations. In fact, they've been dismal misses. Just last week, Nike stock slid after their quarterly profit missed Wall Street estimates. And Samsung estimates that their profits have plunged 96% in the second quarter. Samsung is now bracing for their weakest earnings in 14 years. Samsung Electronics said Friday that it expects its second quarter profit to be the lowest since early 2009. The world's largest smartphone maker is contending with weak consumer demand for technology products. The lowest earnings since early 2009. What happened in 2009? As you know, it was the great financial crisis. One of the worst economic disasters in U.S. history, and now earnings are coming in at the same rate that they were during the worst economic crisis we've seen in the past 20 years. So I hate to continue to compare the current economic situation to the great financial crisis, but the reality is that's where we are. And if stocks are ultimately priced based upon earnings, and if earnings are going to come in as bad as they did during the great financial crisis, that means stocks are going to go down. Now, to be fair, there are plenty of reasons why stocks might not have a major fall, why we're probably not going to hit the October lows from last year, but still, we could easily see a bit of a correction, a little bit of a pullback, if you will. Maybe a 5 to 10% drop in the stock market during this earnings season before we continue higher. A lot of bulls have looked towards the drop in headline inflation as one of the reasons why the stock market should continue to go up. But core inflation is sticky, and trying to get core inflation down is proving to be a very difficult fight. Economists think progress on getting core inflation down is going to stall until the economy weakens. And these fears have led to some cracks in the U.S. stock market that have started to show up. On Thursday, the Dow closed down more than 300 points as the hot jobs data raised fears that the Fed would raise interest rates even more than expected. And earlier in the week, the stock market also sold off when the Fed said that they might not do an alternate rate hike period where they might not raise in July, then pause, then raise, then pause, then raise, then pause. Instead, the Fed is now suggesting that they might do consecutive rate hikes, meaning June was a singular pause, and then they would raise rates in July, and then the next meeting, and next meeting, and next meeting, essentially going back to raising rates every single meeting, because core inflation just is not coming down, and the job market remains much stronger than the Fed would like, and much stronger than what's really going to be required in order to get inflation down. But some still see a golden path to lower inflation without a recession. Even though most economists see at least a modest recession starting later this year, the fact that there's still a chance of getting inflation down without a recession is causing bulls to continue to bring up the stock market. The problem with being super bullish right now is you would literally have to ignore a lot of the economic data. Bulls will very often look at headline inflation coming down as one of the reasons why the stock market should go up, but then they ignore the fact that core inflation, which is what the Fed actually uses, is not coming down, it's just staying flat. Now, it's not going up anymore, which is really good, but it's also not coming down. And then bulls will also look at the job market. They'll look at the fact that the unemployment rate is really low as one of the reasons why the stock market should continue to rally. But then bulls will have to ignore the household data, which shows that fewer and fewer people have jobs, and more people are going out and getting second and third jobs just in order to pay their bills. Bulls would also have to ignore the fact that the average hourly earnings is going down, meaning people are working longer hours for less pay. Bulls would have to ignore all of that and only focus on the few tidbits that they really want to see in order to continue to bring the stock market up. And that has worked quite well for the past 9 months. But we are starting to see a few cracks, because the reality of the economy is consumers are not doing well, and it's starting to show up in earnings as consumer spending slows down, as we saw with Samsung's earnings dropping 96% with their worst earnings since the great financial crisis. And to show you just how bad Americans are feeling the financial pressure right now, here's the salary that Americans say they need in order to feel financially secure. To feel comfortable or financially secure, Americans need a salary of roughly $233,000 a year on average. That's over 3 times the median U.S. household income of about $71,000 a year. Americans are in such dire financial straits right now, they say they need their income to triple in order to feel financially secure. And the reality is, nobody is going to get a job that pays them 3 times more salary than what they're currently making. That's just not reality, which means Americans are going to continue to struggle. So why do Americans not feel financially secure? Well, over 60% of respondents said high inflation was one of the reasons they did not feel comfortable financially. Other factors include the economic environment, which 48% of survey respondents cited, and rising interest rates, cited by 36% of respondents. High inflation and rising interest rates is hurting the American consumer, and at this point, consumers are completely out of money. They've spent all of their savings, they've maxed out their credit cards, and now that is starting to show up in earnings. Over 40% of consumers say insufficient emergency savings and retirement funds contribute to their financial insecurity. But here's the scariest statistic for me. 60% of Americans say they do not have a retirement savings account. 60% of Americans are not saving for retirement at all, and 40% of Americans say they don't have enough saved for retirement, meaning nearly 100% of Americans are either have no retirement savings at all or not enough. And that is a terrible place to be in. Now, of course, I want to help you fix that. I want to help you turn that around. I don't just want to give you market updates and market advice every single day. I really want to help you build your portfolios, especially your retirement portfolios, so that you can become financially independent and you won't have to stress and worry about money. And one of the ways I'm doing that is with the Millionaire Club portfolio. It's a free portfolio that's right here on YouTube, as well as other platforms. You can follow along. Just check the description of this video for the links to the Millionaire Club portfolio. And you can watch all the videos, see the full portfolio, jump in there and participate with us as we work to get you to a $1 million retirement savings account. Now, of course, $1 million isn't really enough to retire on these days. You'll have to do more, but at least this is a good start. It's going to build the habits and get you into the place where at least you have a retirement savings account and you can start working your way towards retirement. And in addition to that, I also want to start some new things this year. Obviously, I've been teaching people how to trade options. It's a lot of fun. We're making money, but options trading itself should be a very small percentage of your overall portfolio. The bulk of your portfolio should be in more longer-term investments that are more focused on retirement. And to help you out with that, one other thing that I want to do this year is I want to start a growth account. We focus in the Millionaire Club portfolio on value stocks. I want to do another account where we focus on growth stocks. And then maybe next year, we'll do another one for dividend stocks. And just really get a good diversification of different types of investment classes that you can utilize in order to grow your retirement savings and hopefully grow it even faster than you would by just doing value stocks. So those are all things that I want to provide for you guys later this year, and just different ways that I really want to help you become financially free and get to that point where you can retire so that you're not working into your 60s and 70s like I see a lot of these Walmart greeters doing. I really want you to be able to retire at a decent age and enjoy time with your family. So I want you to jump in here, join the journey with me. If you haven't already, make sure you subscribe to this channel so you can get all the videos, all the updates. Hit the like button and comment down below what you think about some of these new portfolios that I want to release. Let me know what I can do to help you retire and become financially free. I'm going to work through your comments and I'm going to put it together and make it happen this year so that we can all get there together and we're not struggling to pay our bills like so many Americans are. Let me know in the comments below what you think. And if you missed my last video where I gave some really important market update news, make sure you watch the last video I uploaded here.